Skimming through the news every day, you'll often come across terms such as the S&P index, the Dow and the Nasdaq. But what are they? Well, they all fall under the umbrella of stock market indices, which can be defined as the representation of a security market or a market segment. A market index is primarily made up of marketable securities and is recalculated on a daily basis. Some of the market's leading indexes include the S&P 500, the Dow Jones Industrial Average, the Nasdaq Composite, and the S&P ASX 200 and the S&P 100. They're basically two forms of variations of the same market index, one version based upon the price return, known as a price return index, and one version based upon total return, known as total return index. Ideally, market participants, such as investors and institutional funds, gather and analyze vast amounts of information about the security markets. This is very time-consuming and data-intensive. Some use a single measure that could represent a consolidated plethora of information while highlighting the performance of an entire security market of interest. This is where market indices play a major role, as they often highlight of the performance of any underlying market of interest. For example, the S&P 500 and the Nasdaq are believed to reflect the true performance and a picture of the US stock market and therefore the US economy in general. Likewise, many indexes such as the S&P ASX 200 are believed to reflect the performance of the Australian stock market, and so on. So this is how stock indexes work. Now, if you like this video, you can like, share and comment on it, and you can subscribe to our YouTube channel. You can also press the bell icon for notifications for our latest videos. I'm Rachel, signing off for Kalkine Media.